Good morning, good afternoon to everybody. So want to welcome all of you here today. This is the first webinar we are presenting in a webinar series we're going to be doing over the next few months on doing business in the US and UK. And so obviously today we're going to be talking about UK businesses coming into the US and the different tax and other implications they have in doing this. So these are the presenters for today. So my name is Jared Johnson. I am with Eide Bailly, and Eide Bailly, a little bit about Eide Bailly for those of you who may not know. Eide Bailly is a top 25 CPA firm in the United States. We do tax advisory and audit services. And I am the global mobility practice leader of Eide Bailly. So dealing a lot with individuals with cross-border needs, which we'll talk a little bit about a little bit later on today. I'm going to let Gabe introduce himself. And then after Gabe, I will have Caroline introduce herself.
Thanks, Jared. I'm Gabe Schreiber. I'm a senior manager with Eide Bailly. I focus mostly on the corporate considerations of cross-border international tax. So both outbound tax considerations for US parented companies and inbound tax considerations for companies abroad investing in the US, which is what we're talking about today. I've been with Eide Bailly for about almost a year and a half, 2 years now. And before that, I was with a Big Four for almost a decade.
Thank you, Gabe. My name is Caroline Monk. I'm one of the executive partners in Beaver and Struthers. We're an HLB member firm based in the UK, in the northwest of the UK. Many of you on this webinar will know me in my role as audit partner within the firm. As a firm, Beaver and Struthers offer a full service offering, much like Eide Bailly, and we're very proud that we can support our clients as they expand globally with the support of our HLB colleagues, including Jared and Gabe today from HLB International. And the little sort of prompt for them is that, you know, HLB is clearly the leading network of independent accountants and advisors, advisory firms serving clients throughout the world. And this is just one example of how we all work together to do so. So I'm just very excited to hear what promises for us from the UK side of the pond to be a very informative session to debunk some myths, to provide some helpful information as to what you should think about as you start your international journey. The world is getting smaller. We hear that all the time, but that does give us all great opportunities to expand our businesses, whatever size our business might be. There is a route to expansion. And go global is the theme for today. So over to you, Jared and Gabe.
Thank you, Caroline, and thank you, Gabe, for your introductions and for the introduction here of Beaver Struthers and the HLB network. We're all proud members of HLB, and it is a great and awesome network and to be part of. That. This is the agenda of things that we're going to talk about today. Again, we're going to focus on UK business expansion into the United States and into the US market. So these are the kind of the highlights of the things that we're going to hit upon today. And we are going to start our presentation talking about global expansion to the US. And I'm going to turn some time over to Gabe to focus on this part.
Thanks, Jared. So why the United States? Well, I found this to be an interesting question to answer for this webinar, but I thought this was maybe some highlights to touch on. We have 50 states, about 330 million people, a large GDP, and our per capita GDP does okay as well. I think we're a big trading partner with the United Kingdom. Oftentimes have a lot of clients that call and they want to go to the UK, and we have a lot of clients in the UK that want to come here. So doing business in the US, I think there's different thresholds for what that means. And so we wanted to talk through what that could look like. Maybe you're sending employees, you have an existing business in the UK and you're sending employees to the US for conferences, maybe to solicit sales or explore signing up new customers. Maybe you're hiring employees here, looking for contractors. You could be establishing an office, or it could be a more formal entry into the US of forming a legal entity. Maybe you don't need any physical presence here. You know, it's 2022, COVID has accelerated digital business significantly. So maybe you're just selling physical goods or intangible goods into the US. Maybe you're selling via an e-commerce platform or a marketplace. And so what does that look like? And what does that mean for you as a UK business? And what are your obligations? And so these are all sort of considerations. Usually the early questions that we have when we talk to clients is, what does your business model look like? How are you planning to exploit the market here? What is your presence going to be? Those are things to think about early on, because they'll dictate what direction we go as advisors in helping getting you set up. I think these all have various consequences, both from a federal and state tax standpoint. We'll start with some of the federal considerations, and then at the end, we will touch on at a high level some state tax considerations, especially with respect to Amazon, as that has changed in the last couple of years. So what are the practicalities of doing business here? Because there's a lot of, a lot of considerations, and, there's no one answer fits all. And I guess as I'm seeing the handout links pop up, if you guys have questions, please feel free to participate. We'll pause and try and address questions as we go. But I think one point that I wanted to make is that the level of substance will likely dictate the practicalities of your business expansion. So when we think back to the last slide, if you're forming an entity, you're going to need a lot more help from a legal, banking, accounting, tax perspective. If you're really just sending someone here every once in a while, there's still considerations, but you may not need as much assistance in doing so. Here in the US, accounting firms cannot practice law, so you're going to need a lawyer. Even if we sometimes employ lawyers at accounting firms, but we cannot practice law. So that means we can't draft contracts, we can't form legal entities, we can't do that type of work, registrations with Secretary of State. So you'll need a lawyer to help with that. You're going to need a banker to help set up corporate bank accounts. It may be that the US and the UK have a lot of overlap. It may be that your UK bank has branches here or a partnership with a US bank, and so that may be a good starting place. And then you'll need accountants, not just tax, but you might need someone to put together your books and records. We technically use US GAAP here, which is similar but slightly different from IFRS. And then some considerations with the UK from a practicality standpoint. Tax residency in the US is based on place of incorporation. So if you incorporate an entity in the US, its tax residency will be the US. The UK, as many may know, looks to location of mind and management. And so we want to be careful when we're setting up a US subsidiary that we're not managing that subsidiary from the UK and creating a dual resident company. And so we work with Caroline and our other UK colleagues to set out guidelines and help advise as to what needs to happen in the US and what can happen in the UK to manage those issues. As I mentioned earlier, we have a very good tax treaty with the UK that provides for some reduced rates of withholdings, and also, allows you to have a certain level of activity here in the US before you become taxable. And under the tax treaty, we call that a permanent establishment. Lastly, some things to think about is your capital structure when you're investing in the US. Are you going to contribute capital to equity? Are you going to loan money as debt? I will say generally equity is easier. Debt comes with a lot of different considerations and administrative burden to manage, but it is certainly an option and something we're happy to talk through. As I said, the tax treaty provides for some beneficial rates on intercompany payments. We can get down to 0% in some instances. If not, 5% is usually pretty achievable. 0% on interest, 0% on royalties. Those are very good rates. Most tax treaties with Europe have good rates, but the UK treaty is very strong. So then I just quickly want to touch on common sort of legal entity structures when you're investing in the US. Sort of bucketed it into two categories, either the corporate structure or the pass-through structure. The corporate structure is very common in inbound. We usually recommend a C corporation. The limited liability company is very popular because you can make an election to be treated either as a corporation or a partnership. However, a lot of our other jurisdictions that we do business with sometimes have trouble with the limited liability company. And so if we're going with the corporate structure, the C Corp sometimes is cleaner. It generally protects foreign owners from being engaged in a US trade or business, which is sometimes preferable. And one nuance is you must respect the corporate form. So you have to treat the entity as its own entity and not commingle funds. And sort of it needs to be a standalone corporate entity to achieve that protection. The other structure is pass-through. So either a partnership or a branch type structure. Depending on the activity in the US, the foreign owners may be considered to be engaged in a US trade or business. The consequence of that is that the foreigners, whether it be a company or individuals, may need to file US tax returns. Sometimes that is not desirable. Most people that aren't US persons don't want to be engaging with the IRS on tax matters. So the pass-through structure can sometimes be less desirable for that reason. And then the US has a very strong withholding tax regime. And so foreign owners can be subject to withholding tax on certain items of income, even if cash is not distributed out of the pass-through entity. And as I mentioned, pass-through structure can be achieved either with a partnership or an LLC. Both options are available. So in the US, you can pick your year end. If you default to a calendar year, we have annual filings of income tax returns. The corporate form is the 1120, and it comes with a lot of schedules and disclosures. One form I wanted to point out is the 5472, which is pretty standard when you have a foreign-owned US company. You'll also have state income tax returns. You may have sales and use tax returns as well. And then lastly, we have a form to report items of US source income subject to withholding tax. And so when we have companies coming to the US, we oftentimes provide a slight roadmap on the corporate tax reporting we expect to see. And we certainly at Eide Bailly are able to assist with this. The corporate tax returns are due if you're a calendar year company, March 15th, and you can extend those. They're due April 15th, and you can extend those to October 15th. Partnership returns are due March 15th, and you can extend those to September 15th. And so the partnership form is Form 1065. The 1042 still exists. And one nuance with partnerships is you may have reporting for withholding tax. So there's just some considerations there. We One thing that's a little bit different about the US is we don't require statutory financials to file tax returns. And we also do not require transfer pricing reports. However, while we don't require statutory financials, if you do get audited, you need to produce books and records under US GAAP. And so while they don't need to be sort of in the same form as the UK or filed with the tax return, it is good to have. And then we don't mandate that transfer pricing be done here, but if you don't do the transfer pricing and you get audited and you have an adjustment, you can be subject to both additional tax, interest, and penalties. One benefit of doing the transfer pricing is that you can get penalty protection if it's done under certain reporting standards. And I just kind of covered that. So in the US, we have our own standards, which are similar but not identical to the OECD principles. As I sort of mentioned, you don't need to do it to file your tax return, but it's strongly recommended, especially if you're profitable. It's also in the inbound context, we usually like to suggest transfer pricing so that we can protect the intellectual property and only tax profits accordingly in the US and not allow the US to claim additional profits in the US tax return. And lastly, one thing, foreign corporations doing business here may want to consider filing an 1120F, which is a foreign corporate tax return. There are some very strong tax benefits to filing that return. Even if you don't think you have any US income, we can file a protective return, and that can provide certain benefits to the foreign company. And with that, Jared, I will hand it over to you.
Okay, thank you, Gabe. A lot of information to consider there. So we're going to talk a little bit about remote workers right now, and a little bit more on the individual side of when you consider expanding in the US, and just a little bit of what we're seeing really is that with the expansion of, like we were just talking about before this this call started, we were just talking about Zoom and how big of a, you know, with COVID and all that, all the advancements of COVID, there's been kind of a technology advancement, you know, with wireless internet being throughout the world. There's all of a sudden a desire right now with a lot of employees working for certain organizations to want to go work wherever there is a wireless connection. And so the term digital nomad is kind of landed in our laps. And so a lot of companies are faced with this real issue of digital nomads before you even considering the idea of expanding your operations to another country. And this is really, and it's advanced so much that some countries have provided certain visas where they are welcoming in digital nomads to come into their country for certain. Every country is a little bit different, the ones that do have these visa rules, but countries are allowing them to come in sometimes without establishing any taxable presence in that country. They just want them there to stimulate the economy, you know, and advance their country, you know, by bringing in more people. And so it sounds really great and nice that we have the capability now with internet and with like having virtual meetings with people throughout the world, but it brings with it a lot of complexities and issues that are out there that companies that, you know, what we see and what we're presented with, our clients will come to us and say, I have an employee that wants to work in Spain. What do I need to know about that? What are there any concerns I need to know about? And there are a lot of concerns. And so the organizations are faced with, and that's what we're going to talk a little bit about right now with remote workers. And these are the considerations that organizations have to consider. Permanent establishment and corporate tax. Sometimes when you bring in a corporate work into or an employee of a company, let's say that this it's a UK employee that has relatives in family members in the US, and they want to expand, they want to go live in the US for a while. And these are the type of issues that the UK organization will need to consider. That is this individual creating a taxable presence, or the same thing as a permanent establishment of that corporate entity in the US? Meaning, will that UK company now have to start filing UK tax returns and allocating some of its profits to the US and pay tax on that? That's a real concern. And that's a big concern. That's probably one of the biggest things. The other things that the companies need to, or the organizations need to consider, is employment tax, payroll, and social security. So the basic question comes up as, well, if they go to the US, how do we pay them? Do we pay them from US payroll, or well, we don't have an entity there. So if we were to pay them from the US, how does that even work? Or do we pay them from UK payroll? And this really corresponds with that decision, that payroll decision itself will sometimes trigger permanent establishment. And so you need to be really careful of what, if you decide to keep them on UK payroll and keep them an employee of the UK entity, you could be creating a really big issue for your organization. The other things around payroll that are out there are social taxes. Are they subject to US social taxes when they come here? Or do you keep paying UK social taxes? And the same thing with employment taxes. In the US, there's a lot of things like unemployment, federal unemployment and state unemployment taxes that the employer generally covers. And there's other things out there that the employer generally covers, that now you have to consider these. And, if you're going to pay them on US payroll, do we need to establish an entity here in the US just to do that? And most companies are like, well, for one employee, no, we're not going to do that, that wants to remote work in the US. One of the other biggest issues out there is immigration. How are they going to come to the US? The US does not have a digital nomad visa right now. So do you come and you have them come and work for your UK entity under a temporary visitor's visa? Well, if that's the case, then they're technically here in the US working illegally. And are you going to sponsor that as an organization? So most of the time the answer is no. So then you have to go through the hoops of working through and getting them a proper work visa and getting them documented in the US. And then there's employment and labor law issues that I think a lot of times just fly under the radar, and no one really kind of thinks about the ramifications, of, well, we have to hire them under, the US proper labor laws. We're not working them too much, or, we're giving them, the right US holidays, etc. And then another big issue is pensions and benefits. Are we going to keep them under the UK pension, or if we hire them in as a US employee, or bring them in, somehow set them up as US employee, are we going to provide them a 401k, which is US's type of pension plan they have? And other benefits that you got to consider there as well. So lots of considerations with remote workers. It sounds really great, and it makes employees really happy when they're able to do this, but it causes a lot of headaches for organizations. And it's something we can walk through and help. I don't want to just make this sound like there's a bunch of hurdles in your way. They are hurdles, but they are hurdles you can overcome, and we can work through these. But like the slide says, advanced knowledge of this is critical. Many times we're finding out about this after it's too late. Sometimes maybe the individual's been working in the US for years and you had no idea if they're already a remote worker. And so lots of things to kind of consider, but advanced knowledge, so we were addressing these things, these issues head on, is very critical. So, which leads us into our next topic, is global mobility. And global mobility is the practice of companies sending employees overseas, and when they have a remote workforce, and moving these employees wherever you want to, and doing it in an organized fashion. So we're going to talk a lot about these issues now. We've talked about remote workers and kind of what they do, but you have so remote workers are generally when employees come and ask the employers, I want to move. Sometimes organizations will also have a group of employees where there's a need, and it usually follows expansion. So when you're planning on expanding to the US and you're like, we're going to set up an entity in the United States, we're going to need people from the UK in the US to help this thing off the ground, get it up off the ground. And maybe there's critical knowledge in the UK that needs to be brought to the US, and the employees hired in the US that you need to bring. And maybe these assignments that or the time period you need it could be global mobility practices address a variety of long-term transfers, which is defined in nature by greater than a year. So if you're sending somebody to the US for greater than a year, you have a long-term transferee. If it's a short term, that's another one that's usually less than a year. And then you have other employees that you could consider bringing in, where they just a lot of the times are called frequent business travelers. So you're just like, well, they have a visa, or maybe they have US citizenship or green cards where they can just travel freely however they want. Maybe we'll just send them over to the US on a very frequent basis. And these are all types of different and now we have the issue of remote workers. And so these are all different types of employee transfers that global mobility programs within an organization need to consider, and how they're going to handle these types of things. So generally speaking, global mobility programs, it's a formal program where you have policies and procedures put in place to basically efficiently move people throughout the world. And so there's lots of different perspectives on what a global mobility program is, and it's constantly changing. It used to be that it would just include, people it didn't include remote workers. Well, now there's policies out there for remote workers that companies will have. So the different types of mobility and types of mobility assignments are changing. That kind of goes in line with the top two here. Mobility is no longer just a special program. A lot of times they'd use mobility programs companies would to Fortune 500 companies to develop future global leaders. And now, a lot of it's used to bring on more technical. Maybe there's a special engineer that you need in the United States. So maybe it's geared more for a specific skill or need that's required by the company. So there's lots of different perspectives, and they've been changing of what really a global mobility program is. Why do we bring all this up? We kind of hit on this. I love this slide because it kind of gives you an overview of why this is even an issue when you globally expand. Especially in the US, there's a heightened risk with things like this. And so the population that we're talking about within an organization is usually it's fractional, and it's a very, very small population of people that we are addressing. However, because of the risk that is involved with these specific individuals that are moving cross-border, if they're not filing the proper tax returns, they're not getting the proper visas, they're not getting all these things kind of put into place, proper payroll isn't being done, that risk footprint just broadens and broadens, it gets bigger and bigger. And then what happens is that if you're not managing that risk and that size of that footprint, and you're not watching both of those very good, that cost footprint will blow up on you. And the cost of managing this assignment, these assignments will get bigger and bigger and bigger. And so the risk of this is it's a high risk, as well as the cost of managing these populations. And so a lot of global organizations are keeping an eye on their global footprint, where their people are going, so on and so forth. Okay, so here's an overview of international assignment considerations. And we've kind of hit on a lot of this with the global, with the remote workers, and also with what Gabe was talking about earlier. But some of the ones out there that kind of aren't, in order to keep these assignments organized and we know about them up front, I think this very first one, assignment documentation, is critical with moving employees overseas. You're identifying them, and you have what they call letter of understanding, explaining the assignment type that they're transferring to the United States from the UK entity, what payroll they're going to be on, how cost charges are going to be shared, if there's any incentives to get them to go to the United States, like maybe there's a cost of living allowance that needs to be provided, or maybe they have a family and you have to provide them different benefits, like to help their kids get in schools, and so an education allowance, maybe housing or car allowances would be provided. These are all things that would be documented in this assignment documentation. In order to minimize the permanent establishment risk, there's secondment policies that would need to be put in place to minimize that risk if you want to keep them on UK payroll. There's also there's broader HR implications, which kind of go over those labor laws that we kind of talked about with remote workers. So there's different things we got to consider there, as well as we've talked about the benefits and compensations kind of go along with the assignment documentation. So inside that benefit compensation, we talked about allowances. How are we going to pay them? Are they going to a high living destination, the cost of living, a high cost of living destination, or is it going to be lower from where they're coming from? If it's higher, then a lot of times companies will provide them an allowance to help them overcome that. We've also talked a little bit about Social Security. There's ways to, there's tax treaties in place, and there is one with the US and UK that addresses social taxes. And depending on how the assignment is structured, there's one where if they are a UK employee and they're seconded to the US, then you could use a totalization agreement to get them out of US social taxes and keep them subject to UK social taxes for up to 5 years. And so there's that consideration. Then there's withholding and reporting obligations that need to be considered. So we talked about this earlier. So in payroll, it's not okay for a lot of foreign jurisdictions if you're sending them to work in that country. And I think there's a common misconception that is here. A lot of times people think the tax is where they're paid from. No, the tax is generated from where they are physically present performing a service. So if they're on UK payroll, but they're physically present in the US working, the US is expecting you to report income and pay taxes on that. And it's not okay for the US just that you pay them, that you pay them at the end of the year with the filing of a return. They want that money as you earn it. So I think in the UK it's pay as you earn, or yeah, it's PAYE. And then the US has withholding, federal withholding and state withholding that they would expect you to do. So setting up on proper payroll is critical. There's transfer pricing that Gabe has already talked about. There's those issues with assignments. There's corporate tax issues, especially if they establish a PE in the US, the UK entity. And then there's employee tax considerations. How do they file a tax return? What kind of tax rates are they establishing? State tax issues, etc. And then we've talked about the visa and immigration issues. So all right. So here's the life cycle of an international assignment within an organization and what it looks like. And if you look at this, like, there's a lot here. So I'm not going to spend a lot of time on this, but like, this is the life cycle. If you look at the first, I think 5, 6, 7, 8, shadow payroll, tax review, year-end compensation collection. So right up to 8 is all pre-assignment. So if you have a well-run global mobility program and you're trying to manage this population, the first 8 steps should be done before they go on assignment to the US. These other ones are like tax returns, and you're running shadow payroll, or you're running payroll. These are all kind of during, and then you have some post-tax issues. After they return home, are there trailing liabilities that their assignment created through like bonuses and stock options that you got to consider? And so this is something to kind of like, this is a good guideline for organizations that have a global workforce of things they should consider in their global mobility program. So now we have a lot of myths and facts about global mobility service. I'm not going to spend a lot of time here, but I think we've covered over there. A lot of the myths are this is, there's a lot out there. It's not a big deal, or they're tax exempt because they're here for less than 183 days. It's a lot more complicated than that. So we'll just leave it at that. So when you start moving employees across borders, it gets complicated really quick, and it's really easy to ignore the individual issues, but it's something that should not be done. So we're going to move into some state tax considerations. I'm going to turn the time over to Gabe.
Thanks, Jared. So one thing that is slightly different in the US is how we do our what we call sales and use tax, which is similar to VAT, but also completely different, and something that is very unique to the US. I think we're the only established economy that does not charge a VAT. And so when you come to the US to do business, we have a federal tax, which is 21% right now, which is a great perk of doing business here. Prior to 2017, our tax rate was 35%, and so we were a very expensive jurisdiction, but we now have a 21% tax rate. We have 50 states. 44 of these impose an income tax on businesses. And so in addition to paying a federal tax, there is state tax considerations. We have 45 states that charge a sales tax and 5 that do not. And within the sales tax regime, there are different districts and jurisdictions that can charge sales taxes. I heard once there are north of 50,000 different sales tax jurisdictions, which is overwhelming if I'm being honest. But we have people that specialize in this and can help navigate those rules. And so from an income tax standpoint, the way that states tax companies is you start with federal taxable income, which is sort of how much money are you making in the US on your corporate return. And then this number is apportioned to all the states where the company has nexus. And the apportionment is generally based on people, property, and sales. So payroll, where do you have physical, tangible property, and where are you selling? And so it's not that your bottom line number is taxed in every state, it's that bottom line number is split amongst the states and then they tax it. And so I'd say, you know, people are very concerned about what the effective tax rate is. State tax rates generally range between 4 and 10%. And so ETR, the effective tax rate for companies, is generally around 4 or 5% for states. And one common misconception that I see a lot, which one of the lawyers we work with, he sees the same misconception, is that the place of incorporation has no impact on the federal or state tax liability. And so I oftentimes hear companies want to incorporate in Nevada because they don't have an income tax, or Wyoming. And the reality is that the place of incorporation is a legal issue, not a tax issue. There is a reason why I think like 85% of the Fortune 500 are incorporated at the same address in Delaware. It's funny, if the building is like this old rundown building that has like all of the Fortune 500 is the registered address there, and it's because they're an agency. But the place of incorporation impacts disclosure, and legal issues are usually based on place of incorporation. And so Delaware has very friendly corporate law. So that's something to talk with your lawyers about and understand why Delaware is different than, say, Colorado or California or Nevada. But even if you incorporate in Wyoming where there's no income tax, you may still pay a state income tax. And so that's a big misconception that I wanted to touch on. So I'm not a sales tax expert. I'm gonna announce that up front. We sort of already touched on this. Our sales tax is a tax on consumers, similar to VAT, but it's very different in how it's calculated, assessed. But the one common thing is that it's supposed to be paid by the customer, not the business. If you don't collect it though, and you get audited, you may have to make that payment, which, you know, would cut into margins and not be a good thing. You either, if you have a physical connection with the state, you may be subject to collecting sales tax, like you may have a requirement to collect. We recently had a change in the way that sales tax works. The court case is Wayfair, where now you can have an economic nexus with a state. So a remote seller This is something we see a lot actually with inbound businesses is I'm going to sell to the US. What are my state, what are my tax obligations? And the answer is from a federal perspective, maybe nothing. From an income tax perspective, maybe nothing. But you may have a sales tax collection and a remittance issue. And I see Caroline shaking her head. I feel like she's probably had these conversations before. So remote sellers can create an economic connection or nexus with a state. And you may need to register to collect and remit sales tax. We can help with that. Our firm doesn't do a lot of sales tax compliance, but we can help with advising as to whether or not you're subject to sales tax, what you should be collecting. And we can refer you to a firm that is very good at doing sales tax and is very competitive fee arrangement there. One of the nuances is you probably have to have an EIN, an employer ID number, to register. And so we can help get those set up for you. That's a federally issued number, but the states leverage it as well. So it's kind of funny that you don't have any income tax obligations, but you need to get a number and do sales tax. Each state has different rates. As you can see here, the rates vary. California is a very expensive state, so is New York. Ironically, Pennsylvania can be expensive as well, but every state is different. I think that's the takeaway on that slide. As I mentioned, there are different jurisdictions. So this is North Dakota, and there is a state sales tax. There can be a county, a city, or special district. So it's complicated, I think is the point I'd like to make here. And it's really important to sort of understand where your customers are and work with someone that can help sort of explain what your obligations are. We have these marketplace facilitator rules. Amazon has actually started helping companies with this in the US. I think I've had clients that go to the UK. Amazon can help with some VAT there as well. But as I've seen in the UK, and I'm sure people have seen here, they may not be the best at helping with this. And it's still good to dot your I's and cross your T's, because ultimately you're the one that's responsible, not Amazon. Depending on the state. I think half the states will sign on to Amazon being the collector, but half don't. So you need to make sure you know what you're doing. Again, I'm not a sales tax person. I think you have these slides, so we included more information than usual because we wanted you to have access to it. As I mentioned, they will do it, but there are some states that are not included within the marketplace facilitator rules. And so Amazon is not responsible in those states. And so again, you as a business need to understand the rules and where you are expected to collect and remit sales tax. These are the dates for, the states that have adopted the marketplace facilitator rules. Let's see here. We've kind of talked about the different types of connection. This slide I think is helpful. Most states have signed on to 100,000 in sales being the tipping point for being subject to sales tax. I think California is a little unique, and New York can be unique as well. Some states have a quantity threshold, so every state is different. I think the takeaway here is reach out, let us put you in touch with a sales and use tax person that can understand your business and provide guidance as to what your obligations are. I see there were a couple questions. The first question is there a requirement to have at least one US resident director shareholder when incorporating a US corporate entity? That is a legal question. I am not sure what the answer is to that. It probably depends on the state. A minimum level of share capital, technically no, but we have debt to equity and thin cap rules to consider. If you're very thinly capitalized, it may be that the debt looks more like equity, and therefore the US can recharacterize the debt as equity, and any debt payments are actually dividend payments. So it gets really messy. So we always like to have a clean capital structure. How long does it take to incorporate a US entity? Again, that's a legal question, but I think we can get it done in a week. A lot of states are pretty quick, especially like we have services here. I would not recommend using them, but like LegalZoom can get it done very quickly. But I think it's important to contact a lawyer and work with someone to draft articles of incorporation and understand what your obligations are when you're forming these entities.
Really quick, I was gonna jump in on that. And
Yeah.
when Gabe says it's a legal question, in the US, accounting firms can't practice law. So and I think that might be, Caroline, that might be a little bit different for the UK, where you guys can have attorneys in your CPA firms that practice law.
Yes, we can, though it's not really very common, but we can. But I think the main difference is that in the UK, it's not unusual for the accountant to assist in the incorporating of the company. That is a service that we would typically undertake, whereas that's very different in the US. I think you use specific agents to help you in that process.
Okay.
Yeah, and I think it can be done very quickly though.
Yeah, you can. It just, in the US, you just have to engage with the law firm to do like the legal setup and some of those legal questions related to setup. And that's the other thing about the setup of an entity. It's done at a state level, not at a federal level. So again, you have like 50 different states that have different rules, and so it's important to get the right attorney involved. So anyway, those are kind of my comments. Go ahead, Gabe.
Yeah, and so the next question is opening a corporate bank account difficult? Oh boy. I think if you have an entity, it's not, because you have a US employer, we call it an EIN, it's the employer identification number. I think when you have a legal entity, it's relatively easy to get a bank account. I think when you're a non-resident trying to get a bank account, it can be a lot more difficult. And that's where working with the huge banks that have UK offices as well as US offices, sometimes it can be easier. I sort of mentioned early on, you'll need accountants, lawyers, and bankers. And we can refer you to lawyers. I would recommend, if you have a big bank in the UK that you work with, talking with them. Now, if you use a smaller bank, we have bankers that we work with here in the US that we can make referrals to, but banking laws are complicated, especially in the US, because we have a history of people hiding money in Swiss bank accounts. And so we've passed a lot of legislation around account owners. In Europe, they've passed the Know Your Client, KYC, if you're in the Netherlands, AML, anti-money laundering. In the US, we have FATCA, which is all about banking and understanding who you're doing business with, and it's complicated. And so opening a bank account, if you're a non-resident, again, you're going to need a banker, but it depends. And the last question I'm seeing here, do all corporate entities in the US have to have their accounts audited by an external auditor, or is this only required for entities above a certain size? There's no requirements to be audited in the US. Not legally. Like banks may have requirements for audited financial statements. You may have other businesses that require audited financial statements, but the government does not. The IRS will want books and records maintained in accordance with acceptable accounting policies, and there are certain requirements there, but it does not need to be audited. That is a difference between the UK and the US. We don't have a statutory financial requirement, but at some point your bankers might require it. Lease negotiations might require it. Certainly if you're going public or have public debt, that is something that will be required. Of course, a lot of times raising capital, they'll want audited financials, but it can be done out of the UK with the US being sort of a subsidiary. You don't have to just do a standalone audit. Carolyn, I don't know if you want to add any context to these questions from your point of view and having advised UK companies investing into the US. I realize we're sort of in the last minute here, but I'll let you sort of chime in with anything you want to add or any points you want to make at the end here.
Okay, thanks, Gabe. Yeah, I'm very conscious of time, so we'll stick quickly, but I think they were really helpful comments and questions. It's interesting in that they're the questions that come to us when we're looking at advising overseas companies coming to the UK. And it is interesting that although there are so many similarities between the different jurisdictions, there are also so many differences, aren't there? So I think the main take home I'm getting from all of this conversation that was really helpful. Thank you both, Gabe and Jared. Is don't do anything without speaking first and taking advice. I think the worst sort of call any of us receive as advisors is clients saying, "I've just done," because you're already caught in a position. The even worst is when there's no call at all and you discover something's happened by some ways. I think my big takeaway from today is just don't pay anyone anything without taking advice, wherever they may be based and whatever they may be doing, because it comes back. And my final sort of point is you know, the US might be seen as being an expensive place to do business, but I think that reference that you've given to what to do is really helpful, just for controlling your costs, controlling your risks, and understanding the implications of what you're doing. Because boy, we might think VAT is complicated in the UK, but it's nothing on you guys and your sales tax. So hats off to you all, and thank you very much.
Thank you.
Thank you.